Bismillahirrahmanirrahim. Assalamu alaikum. I am Syed Akif Shah, lecturer finance at Institute of Business Studies, Kohat University of Science and Technology. The title of this course is Financial Management, and the course code for this subject is BS 251. This is our lecture number 28, and the topic for today's discussion is account receivable management, under the umbrella of which specifically we'll discuss the changes or alteration in the length of credit period to the customers, and as well as the cash discount, if any, offered to the credit customers in order to expedite the collection of account receivable over the credit sales. So basically this lecture is in continuity to my previous lecture, which is lecture number 27, where we have already discussed what is the basics of account receivable and how a particular factors, if it is altered, will result in expediting the collection of account receivable, or what kind of impact such alteration will have on the profitability and cost trade-off. So let's discuss the outline of this lecture specifically. Once again, we'll discuss how to manage our account receivable efficiently in this lecture. Specifically, the emphasis will be on the credit and collection policies, under which we'll discuss the second factor which will be altered while you are managing the account receivable, in order to see that either we can increase our profitability with such alteration or change, or such change is not suitable to be opted by the company. Similarly, we'll also see that if we offer any cash discount for early payments by the credit customers, then what kind of impact this cash discount will have on the early collection of our account receivable, and as well as any cost associated with that cash discount if availed by those credit customers. So let's go ahead to recap our previous lecture, and as well as to furnish ground for this lectures to continue and to cover up the next two factors or phenomena which can bring certain change in the profitability and cost involved. So basically, the learning outcomes of this lecture is to understand the profitability and cost trade-off. That is, if we change the credit policy of the customer if we change the credit policy to the credit customers or credit applicants, then what kind of impact this change will bring on the profitability and cost of the company. Secondly, understand how the level of investment in the account receivable, that is, let's suppose if we are accepting all the credit applications and selling our products to those prospective customers on credit, then it will result in a huge amount of investment or funds tied up in the account receivable section. So we have to select or choose the best credit applicant on the basis of credit rating and as well as our own past experiences, in order to increase the company's profitability and to minimize the cost of funds tied up in the account receivables. Finally, or thirdly, we can say that critically evaluate the proposed changes in the credit policies, which is the basic agenda of this lecture, that will alter the two different policies of the company for credit customers, and we'll see like changes in the credit standards, which was in detail discussed in the previous lecture. However, the emphasis of this lecture will be on credit period and cash discount alteration, and to check out the impact of these changes or relaxation in the company's policy, how fruitful these changes are for the company's profitability. Finally, we'll also see different sources of information on the credit applicants, that is, you might use for analyzing the credit applicants and to accept its application or to reject its application for credit sale. So let's go ahead. Here we have our broader diagrammatical shape of credit and collection policies of a typical manufacturing firm, in which we have already discussed the quality of trade accounts and their impacts on the average collection and bad debt losses. Along with that, we have discussed in detail the trade-off between the company's profitability and the additional funds tied up, against which we are missing the opportunity saving or opportunity cost. We are incurring actually the opportunity cost if we are not investing those funds in any other prospective profitable investment opportunity, and we are just leaving that opportunity in order to accept more and more credit applications and sanctioning loan or offering them our products on credit basis. So the emphasis we'll start in this lecture from our second factor, which is the length of credit period, and as well as the possible discounts. What kind of impact if we change the credit period to the credit customers it will bring on the company's profitability. Similarly, what kind of impact the cash discount will have on the company's profitability, and as well as the additional cost involved if the credit customers are accepting these cash discounts. So let's go ahead to discuss the changes in length of credit period to the credit customers or to the prospective customers of the company, and what kind of impact this change will bring on the company's overall profitability and cost. If the profitability is greater than the cost involved while changing the length of credit period, then we'll go with the next new change or alter policy, because the total profitability or additional profitability is quite greater than the cost associated with that change. So let's go ahead and to discuss this policy in detail. Here we have our second policy, which is length of credit period, which will be changed shortly. With the help of a numerical case, we'll elaborate or explain this in detail. So let's move ahead. Now, what is a credit period or a credit policy? The credit terms, how could we define it? What are the credit terms? These are terms and conditions of credit sales basically. Here it is specify the length of time, like the credit terms are actually specifying the length of time allowed to the credit customers over which credit is extended to a particular customer, and any discount. Basically, it involves two main terms or rules and regulations. Firstly, the length of time or the number of days allowed to the credit customer to pay out their obligation to the company. Secondly, the discount, if any, offered by the company to the prospective credit customers for early collection or early payments. For example, we have written over here a particular narration which can be read as 210 net 30. Now, what does this narration means? That a particular company is offering credit sales to the prospective customers on the basis of maximum length of time period of 30 days. However, if certain customers would like to have a discount of 2% on overall payments to that particular company, they are required to pay out their obligation within 10 days. That is, rather than to wait for the 30 days to be completed, they are required to pay out their obligations within 10 days. In that case, the company will offer them 2% discount. Like for example, after the completion of 30 days, a credit customer is required to pay out $100 to its supplier, and if this customer would like to earn a discount, this customer will have to pay out its obligation within 10 days. And if this customer is opting for the payments within 10 days, the company is offering 2% discount. So if we multiply 2% with 100 total obligation, we come up with $2 of saving. It means that if a credit customer pay out its obligation or its accounts receivable, or not on account receivable but actually on their purchases, the company will offer them $2 of discount, and rather than to collect the complete $100 against their sale, the company will receive only $98. So such kind of terms and conditions are known as credit terms. Let's move ahead. What is known as a credit period? The credit period, as I have already explained, that it is a total length of time over which the credit is extended to a customer to pay the bill. For example, net 30, as I have already explained, that the total time period allowed for a particular credit customer to pay out their debt obligations to a particular supplier or company is 30 days. So it requires full payment to the firm within 30 days from the invoice date. The credit period is actually the total length of time, and this 210 net 30 means that the customers are provided with 2% discount for early payments. And this actually results in the early collection of accounts receivable by the company, which can be, and these funds can further be utilized to sanction the credit sales to the other prospective customer, and hence the company may increase or enhance its profitability. Now, in the numerical context, we'll explain shortly that how this kind of relaxation and offer can be beneficial to the prospective and as customers and as well as for the company. So let's take an example of a numerical case with a particular company. That is, we are going to relax the credit period to our customer. By relaxation, we mean that previously they would have been required to pay out their obligation, or let's suppose in 30 days, and now we are relaxing our credit time period to the customer to pay out their obligation in the next 60 days. So in that case, we are actually talking about the relaxing the credit period. So rather than to waste on the hypothetical examples, let's look at the rectangle and to study this numerical case to understand what impact this relaxation will have on the company's profitability and as well as cost. So here we have taken example of a company named as Basket Wonders. Let's quickly read out the narration and to understand the phenomena. The Basket Wonder is considering changing its credit period. So here, once again, we are encountering with a certain alteration in our credit and collection policies. They are changing their credit periods from net 30. Like previously, they were offering their products to the prospective credit customers if they were willing to pay out their obligations within 30 days. And this net 30 means that it has resulted in a 12 account receivable turn per year. Now what does it mean? It means that in 1 year of time period, if the customers are paying after 30 days, then we know that we have 12 months in a year, and 30 days comprises of one complete month. So therefore we can infer that in a year on average there is 12 account receivable turns. What does it mean, account receivable turnout or account receivable turn? It means that, let's suppose if the company is selling out their product of $1,000 to the prospective customers and they are required to pay out their obligation within 30 days, then after 30 days these account receivable will be zero and it will be converted into our cash amount of $1,000. So when our account receivable converted into cash after collection, it is known as account receivable has turned out into cash. So by 12 account receivable turnout, we mean that on average, the company is receiving or collecting its account receivable, and these account receivable are converted into cash by 12 times in a year. Now, the company is looking to alter or change its credit term, and they are looking to increase the credit term period to 60 days. Previously, they were collecting within 30 days. Now they are looking to change their credit policy and particularly the credit period towards 60 days, which is expected to result in 6 account receivable turnout. Like we know that if the customers are paying out their obligation within 60 days and this account receivable converted into cash after 60 days, so it means that if we divide 365 days by 60, we will have our resultant value of 6 account receivable turnout. Now what does it mean? That if the company is going to change its credit period, then on average 6 times in a year, company will turn out their account receivable into the cash, or they will going to collect their account receivable. So here, after understanding the account receivable turnout and change, let's move ahead as we are continuing with our previous example. So in order to have a full grasp on this lecture, you have to listen to my previous lecture where we have started the example of Basket Wonder, where they are providing only a single product. So basically this lecture is continuing with the same example with certain change in the credit period. The firm is currently producing a single product with variable cost of $20 and selling price of this product is $25. So the selling price is $25 and the variable cost of this product is $20. So therefore we can calculate that the profit margin per unit for this company is $5. If we subtract cost from the sale price, we will have $5 of contribution margin. Looking further into the additional information, because of this change or relaxation in the credit period, more and more customers will approach towards Basket Wonder in order to purchase the product from this company, because previously they were unable to pay out their obligation within 30 days. So for those customer, company has actually altered their credit policy and have relaxed them towards the net period of 60 days. So when they have altered it, more and more customer or the credit customer will approach to this company for purchasing that specific product. So because of this alteration, there will be an additional annual credit sales of $250,000 from the new customers as forecasted, in addition to the current $2 million in annual credit sales. Like before relaxing this credit period, the company was having $2 million of annual credit sales, but after this alteration of net period of 60 days, additional credit sale is $250,000. So it means 2 million plus this additional sales. So there will be $2.25 million of total annual credit sale after the alteration or relaxing the credit periods. So let's move ahead with further auxiliary details or information, and then to find out the profitability and cost trade-off. Additionally, we have been given with the data of before tax opportunity cost for each dollar of funds tied up in the additional account receivable is 20%. Now, what is the meaning of this information, or why this information is important? Because if we are going to accept the additional credit customers, it means that we are going to stack our $250,000 in our additional account receivable. What if we have not altered this credit period? So in that case, we might have this additional $250,000 in our treasury, which could be invested in any other investment opportunity available in the market. So the data is telling us that if the company might not have altered its credit period, then they will have those $250,000 of funds available in their treasury, which could be invested somewhere else that could provide them 20% of return. So basically, as we are foregoing this investment opportunity, so therefore this foregone investment opportunities earning is actually known as opportunity cost, and we will have to compare this second option earning with our current earning from the additional account receivable, and then we'll to decide either to go for relaxing the credit period or not to go with the relaxing the credit period. Additionally, the question is stating that we have to ignore any additional bad debt losses, as we know that if we are relaxing our credit period towards net 60 days, then ultimately the credit customer, there are highly likely chances that they are going to default on their payments to the company, and we will have certain percentage of account receivable which turned out to be a bad debt loss. So it could be like 2% of the account receivable, or some people or credit customers are there who are not going to pay out their obligation on due date to the company. So higher the length of the credit period, the greater the chance of bad debt losses. So we have to take care of the bad debt losses to the company if we are relaxing the credit period to the prospective credit customers. But here the question is saying us that we have to ignore the additional bad debt losses because of this relaxation. Otherwise, it will be quite complicated numerical case to calculate the profitability and cost involved. In the subsequent lecture, I'll definitely address the bad debt losses and how to cater and deal with those losses, and then to decide that either we should go with the credit and collection policy change or not to go with that. However, in this particular case, in this lecture, the question is stating that we have to ignore the additional bad debt losses that may arise. So our final question is, should the basket vendor relax their credit period or not? So under these numerical data and conditions, or terms and condition of relaxing the credit period, the question is asking us whether the basket vendor should relax their credit period to the customers or not. So let's move ahead and to calculate the company's marginal profitability and as well as the additional cost involved in the funds tied up in the account receivable, and then to compare both of them to have our final decision that either the company should go with the credit period relaxation or not to go with that. The example is here that the profitability of additional sale in the step first should be calculated. The profitability of additional sales is that we have already calculated that the profit margin or one unit is actually $5. And as we know that we are going to have additional sales of $250,000. and we know that the price per unit is 25. So if we divide 250,000 of additional account receivable or additional sales by the unit price of the product, we come up with 10,000 units of sale. So we have calculated the additional unit sale by dividing the additional sale by the sale price per unit. So if we multiply the total units sold out because of the relaxation in the credit period with the contribution margin per unit, we will come up with 50,000 of additional profitability. Step number 2 is to find out the additional account receivable. As we know that the company's account receivable turnout will change from 12 tons to the 6 tons if they are relaxing their credit terms from net 30 to the next net 60 days. So these are basically days required to pay out their obligation, and these are basically account receivable turnout. So in that case, we have to divide the total amount of sale by the new account receivable turnout, which is 6. Therefore, we come up with 41,667 additional account receivable tied up in this sale because of relaxing the credit period. In the step number 3, we have to calculate the cost of funds tied up if we are going to relax our credit standard. In that case, we have to find out the investment in the additional receivable, as this is the actually sale price, and therefore we have to find out the cost of goods sold in this 41,667. For that purpose, we can divide our variable cost with the total sale price, and it will have 0.8 or 80% cost is involved in any dollar amount of sale. So after multiplying our variable cost margin with the total additional account receivable, which is 41,667, we come up with $33,334 of funds tied up or stuck in this additional account receivable if we relax our credit period. Previously, the account receivable level was, the old sale of company was $2 million, and the previous account receivable turnout, as we have the terms of sale, was 30 days. So therefore 12 account receivable turnover were there. Therefore the previous level of account receivable is $166,667. In the next step, we have to calculate the funds tied up in this previous account receivable level as well. After the policy change, this change in the policy is also implementable on the previous customer as well. So basically, after relaxing the credit period, our old customers will also be looking to pay out in next 60 days. That is, they are also utilizing the time value of money phenomena, and they are trying to use the delaying tactics. So therefore our account receivable turnout has been changed to the 6. Therefore the new account receivable in our original sale is actually now $333,333. So this is basically our new account receivables level for our original sale. We have to find out next the investment in the additional receivables, that is in the original sale. So previously we have $166,667 for funds tied up in our account receivable, but after the change in the credit period of net 60 days, the account receivable turnout reduces to 6 tons. Therefore we have an additional amount of funds tied up in the account receivable section. We can subtract it from new account receivable. We will have our resultant value of $166,666 in addition to the previous account receivable. The next step is to find out the accumulated total investment in the account receivable. So the total investment in additional account receivable is actually those 33,334 from the previous step. As we have calculated over here, we can see that here are the additional account receivable investment, and then we have this amount as well in our original sale. Now an additional account receivable has also been generated, and this additional funds are tied up in the previous or old sales. Therefore, the final total investment or total amount stuck in our account receivable, which are additional account receivable because of alteration or relaxing the credit period, is now $200,000. As we have calculated the profitability in our very first step, let's move back. Because of this relaxation or change in the credit period, the additional profitability to the company was $50,000, and the additional funds tied up because of relaxing this credit period is $200,000. The final step is to calculate the required pre-tax return on additional investment. In that case, you have to apply the opportunity cost percentage, which was given at the start of the question, on this total amount of investment in the additional receivable. So if we multiply the opportunity cost on the additional account receivable, which are total additional account receivable, then the pre-tax required return on this investment is $40,000. Now, what is the meaning of this last calculation? It means that if the company might not have relaxed their credit policy, that is not to relax their credit policy, and to invest these amounts somewhere else in another investment opportunity, that investment opportunity could provide them 20% return, but that is pre-tax return. So this was the second option. So therefore, the trade-off between profitability and cost, or the opportunity cost, should be compared with each other. So the second option was providing us with $40,000 of earning. However, if we relax our credit period, then the additional, let me remove all the ink, then the additional profitability because of this credit policy relaxation is actually $50,000. Hence, we can conclude our decision that the total profit realized after relaxing the credit period is greater than the required pre-tax return of $40,000. That is, $50,000 of profitability is greater than $40,000 of required pre-tax return. Therefore, the final decision with the basket founder will be to alter the, or to change, or to relax the credit period to the customers, or to the prospective customers, credit customers in particular, I must say, because the profitability is greater than the cost or required pre-tax return. The decision will be yes, to go with relaxing the credit period to the prospective credit customer, because it is actually enhancing the company's overall profitability. So here we conclude our lecture, and in our subsequent lecture we will discuss the third point, which is possible cash discount, and what kind of impact this discount will have on the company's profitability, and as well as on account receivable management, that is to expedite the collection on account receivable. For the time being, this was all about with the account receivable management and the second factor which have impact on the overall company's profitability and cost involved. Thank you very much for listening to this lecture. If you have any question, a query, or confusion, you are free to ask on KCMS, or otherwise you can also email me with your queries on my email address as mentioned in the footer of this lecture. Good luck for the day. Allah Hafiz.